In this video, we're going to go through this modified three-statement model, and I'm going to show you some of the key points, how it's different from the model that we looked at before with Apple, and then how you can actually use it and use it for practice purposes when you're preparing for investment banking interview questions. So to start with, you see these two new sections here at the top for assumptions and interview questions. Now, interview questions, this section is pretty obvious. Basically, what this lets you do is actually enter in changes to the common line items on the three financial statements. So revenue, cost of goods sold, depreciation, the balance sheet items like accounts receivable, inventory, capital expenditures, and then moving over to financing and long-term liability related items that let you modify how dividends work, how interest is paid out, how shares are repurchased or issued. So you get to modify all these variables. And the format for these lessons will be that we're going to walk through several examples of how these different line items change. I'll walk you through the three financial statements, starting with the income statement, then going to the cash flow statement, and then concluding with the balance sheet and show you where these changes actually impact the three financial statements and which line items actually change. Now, once I get done doing that and we've been through all the sample questions, you can actually go in and do some further practice yourself and go in and look at how I've modified the model to support the formulas for some of these changes and some of these interview questions as well. The assumptions section over here, we need this one because we're going to be modifying some items related to taxes. You remember that in the Apple model before for the tax rate, we just assumed a constant tax provision. In this case, though, we're going to be assuming a 40% tax rate. That's going to be necessary because when we walk through the three statements, in a lot of cases, when the income statement changes, we need to know how net income changes, so we need to have a tax rate for that. And then same thing goes for the others here. We need these because some of the additional changes that we're making will require us to have this data and these variables. The current share price of stock, this just refers to when you go into E-Trade or your own personal trading account and you go to buy a share of a company, what's it trading for in the open market? The par value, by contrast, is just a book value number. When a company issues stock, it assigns a par value to the stock. I've just set it at $1 here. Often it's 1 cent per share or a tenth of a cent or a hundredth of a cent or something very low to indicate that shares by themselves have relatively no value. It's really all about what the market thinks the shares are worth. But we need to take into account both of these because we're going to need them when we go through some of the questions on issuing and repurchasing shares. Now, to walk you through some of the changes on the three statements here, so the income statement is similar, but I have revised some of the names. So net sales is now revenue, cost of sales is now cost of goods sold. Operating expenses, pretty much the same. I've added in depreciation and stock-based compensation here. These could technically be operating expenses or they could fall under the scope of cost of goods sold. In reality, companies actually do all three of these. Sometimes they list them under cost of goods sold, sometimes they're under operating expenses, sometimes they're separate line items, but the effect is always the same. They're always going to reduce operating income and thereby reduce pre-tax income. I've just listed them separately to avoid confusion on what they should be classified as. I'm just listing them as a completely separate item here because the important thing for accounting questions is not what they're classified under, it's what effect they have on the operating income, the pre-tax income, and then the net income. Some of these additional items under operating income here, mostly the goodwill impairment and the write-downs, these are going to be necessary because we're going to look at a couple interview questions on these topics, and especially when the economy is not doing well, when companies are struggling, it's common to get questions on these. The impact on some of these will be to reduce the pre-tax income, but then others will actually raise the pre-tax income. So we'll get into the details behind those. The income tax provision here, basically all we're doing is multiplying by the tax rate. So we're taking this 500 million pre-tax number, multiplying by the tax rate, using that to get our income tax provision, then subtracting that to get to our net income here at the bottom. And then earnings per share works much the same way. We're simply taking our net income and dividing by shares outstanding to get to this number. Now on the balance sheet, much of this is pretty much the same. I've streamlined some of it and moved around some of the items. I've cut out some of the long-term assets here for simplicity, but the items here are pretty much the same. On the liability side, I've added in some debt-related items, the revolver, and then long-term debt. I've also created this new item for deferred tax liabilities. We'll get into that in one of the questions later on. This is basically the opposite of a deferred tax asset. So increasing a deferred tax asset is the same as decreasing a deferred tax liability and vice versa. This new item for dividends declared, we'll need this when we start getting into dividends, but this is a temporary entry that companies enter when they declare a dividend, but before they actually issue the dividend. And then shareholders' equity, all these items are the same. The only difference is that this time some of these will actually change because I've created the support for these and enabled support for some of these items to actually change as a result of other changes in our model. Now in the cash flow statement, the top part here is similar. We basically have net income and then all the non-cash items. So depreciation, stock-based comp, impairments, write-down, deferred income taxes. We've been over these previously. Changes in operating assets and liabilities, pretty much the same as the Apple model. This one is streamlined a little bit because we're only focusing on the 5 or so key items here. Investing activities is greatly streamlined because we only have long-term investments and capital expenditures. And then financing activities, we have a couple more items here. We have dividends, long-term debt being issued or paid off. We have an equity bailout, again, highly relevant when the economy is poor. And then repurchasing and issuing new shares here. So those are some of the key changes to our three-step model. One other additional point I want to raise is that when you go into this and you start modifying it, feel free to modify anything on the new side, and anything on the new side of these three statements should flow through correctly. But stay away from changing anything on the old side. The reason is that it's not going to flow through correctly and you're going to get out of balance sheets and the other statements will not work correctly. You should really be focused on the new side because for interview purposes, you want to be focused on how the changes to the three statements actually impact things as opposed to how changing the original model will actually impact things. So you want to stay focused on the new side. And of course, feel free to modify anything on the interview question side as well. You can even add in some of your own items. There is one area here where you have to be a little careful, and that's with the dividends declared and issued, and we'll get to that one when we get to the video on dividends specifically, but for the most part, for the other ones, you should be fine just modifying them at will as you wish, as long as you enter in reasonable numbers here, and that will be actually really good practice for you to get used to getting these questions and answering them in the context of interviews. So that's an overview of the three-statement model, how I've modified it over the Apple model that we've looked at before, the assumptions, the interview questions, and then how the income statement, balance sheet, and cash flow statement are now different. Coming up next, we're going to get into the actual interview questions, and I'm going to start with the most basic one, which is how to walk through the three financial statements in the context of an investment banking interview.